A secret buyer just scooped up 9 prime properties in Malibu. But this isn't an isolated deal, it's a wave of foreign cash reshaping California real estate today. Hi, I'm Steve Moon of the Steve Moon Group, your San Jose Realtor, talking about everything that's real estate related on this channel. That's right, 9 prime lots in La Costa Beach in Malibu, all bought in cash. And while that sounds sort of like a headline straight out of a Netflix drama, it's actually a part of a much bigger trend that we're seeing today. Foreign investors are coming back into the US housing market in a big way, just as many Americans are stepping back. And the timing isn't random. It's all tied to 3 things: a weaker US dollar, a higher mortgage rate, and tariffs that are feeding inflation. Put all of these things together and you get the perfect storm for overseas buyers to swoop in while everyday Americans feel locked out of the game. So let's start with the numbers. According to the National Association of Realtors, foreign buyers purchased some 78,000 US homes worth about $56 billion from April of 2024 to March of 2025. That's a 44% jump in volume and 33% increase in dollar value, the first since 2017. And here's what's interesting. Nearly half of these buyers live outside of the United States. So we're not talking about immigrants buying, family homes. This is pure international investment play. China leads the pack again, accounting for some 15% of purchases and $13.7 billion in sales. Chinese buyers prefer luxury properties averaging over $1.1 million per purchase compared to the overall foreign buyer average of about $719,000. And it's happening everywhere that really matters: Miami, New York, Los Angeles, San Francisco, Silicon Valley, all seeing surges. California jumped to the second most popular destination, capturing 15% of all foreign purchases. In fact, more than a third of Chinese buyers chose California properties. The message is clear. Global money sees American real estate as an attractive purchase again. So why now? The first big reason is the US dollar. In the first half of 2025, the dollar dropped by about 10 to 11% against all other major currencies internationally. So that's its worst start to the year in over 5 decades. Now, if you're buying properties in euros, pounds, or the yuan, that drop makes American real estate look like it's suddenly going on sale. So let's put some numbers to get proper perspective. Imagine $1 million condo in Miami. In 2024, that might have cost a European buyer about 930,000 euros. But by mid-2025, with the weaker dollar, that same condo is closer to 830,000 euros. That listing price in US dollar hasn't changed at all, but in your local currency, it felt like a 6-figure discount. That's a huge incentive. It's the same math that makes a $65 million Malibu purchasing spree suddenly pencil out for a foreign buyer sitting on a lot of cash in hand. Meanwhile, the story looks very different if you're an American trying to buy with financing. As of late 2025, the average 30-year mortgage rate is sitting around 6.6%. That's more than double the rates that we saw in early 2020s. And what does that mean in real life? On a $700,000 home, that higher rate can add hundreds and if not thousands of dollars per month to your mortgage payment. For a lot of households, that's the difference between being able to qualify for a loan and being completely priced out altogether. And we're seeing the ripple effects as well. Home builders are reporting weaker buyer traffic. Builder confidence actually slipped back to probably levels that we haven't seen since 2022. And to move inventory, many builders are offering incentives, things like rate buy downs or just simply doing price cuts. And that's great if you're a buyer who can still qualify, but it's a sign that affordability is becoming a very difficult problem. Now here's where tariffs tie everything together. Tariffs are basically taxes on imported goods. And when tariffs go up, so do prices of things that Americans buy: steel, electronics, furniture, and even construction materials. Economists at Yale estimate that the current tariff situation is pushing US prices up about 2%. And that's in the short run. That may not sound huge, but it matters because it keeps inflation sticky. And sticky inflation means that the Federal Reserve is less likely and less willing to cut interest rates, which also means that the mortgage rates stay high for a longer period of time. So the chain reaction looks something like this. Tariffs equal higher consumer prices, which equal inflation sticking around, which equals the Fed keeping rates elevated, which equals Americans facing higher mortgage costs. But there's another twist though. Tariffs can also hurt trade and slow growth. That tends to weaken the US dollar even more. So tariffs aren't just making it harder for Americans to finance homes, they're also making those same homes look even cheaper and cheaper to foreign buyers paying with stronger currencies. So put all this together and you have the perfect storm. The weaker dollar makes US real estate look like a bargain to overseas buyers, and higher mortgage rates keep American buyers on the sidelines. And tariffs feed inflation, which locks those mortgage rates in place while keeping the dollar under pressure. That's why we're seeing wealthy foreign investors buying up luxury assets, like those 9 Malibu beach lots, while young Americans can't even qualify for a condo loan mortgage. It's not that the foreign buyers are taking homes away from Americans, it's just that the economic situation is tilting the playing field in their favor. Cash buyers with foreign currencies simply have more leverage right now than Americans. So, what does this mean if you're in the market yourself? If you're a US buyer, this is the time to look for builder incentives, seller credits, and rate buydowns. Those things can take the edge off monthly payments. So you may also find that more price reductions in homes that have been sitting around on the marketplace, especially if they don't attract cash buyers. If you're a seller in a market with lots of foreign buyers, places like Silicon Valley, LA, Miami, or New York City, it could be smart to market more internationally. Remember, a $1 million listing here might feel like an $850,000 deal to a foreign buyer, depending on exchange rate situations. Highlighting that can make your property stand out from other properties. And if you're an investor, be aware that foreign cash competition is likely to remain strong in the prime, globally visible marketplaces. Here's the thing. This story is far from over, and the next few months could completely flip the script. Watch the dollar very closely, because every percentage point that it drops is like putting another discount sticker on American real estate for those foreign buyers with cash. But if it rebounds, that foreign money could dry up very quickly. Then there's also mortgage rates. Right now, they're the wall keeping millions and millions of Americans out of the marketplace. But the moment that the rates drop below, let's say 6%, and I mean the moment that it happens, you're going to see a flood of domestic buyers rushing back into the marketplace. That could spark a bidding war that we haven't seen in years. And here's the wild card: tariff policy. New tariffs could send the dollar tumbling even further while pushing rates even higher. But the tariff rollbacks, they could stabilize the inflation, giving the Fed room to cut rates and suddenly tilt the playing field back towards American buyers. The bottom line? We're sitting at an inflection point where small policy changes could trigger massive market shifts. So that's the bigger picture. A weak dollar, high mortgage rates, and tariff have all combined to create this moment where US real estate feels like a discount for foreigners, and also an impossible dream for many Americans. If you want more deep dives into how economics collide with housing markets right now and here at home, Hit that like and subscribe and share your thoughts in the comments below. I'd love to hear what you're seeing in your local marketplace. So see you until the next video.